Got it.
All right, good evening, SARS.
Good evening.
All right, so this is our second in the series of workshops from phase one on financial freedom, and this one's on debt reduction. Last month we started with savings. How many folks were here for the savings workshop? All right, so some of the information is repetitive from last month, but we have a lot of information to cover tonight. So some of it I'm going to repeat, but a lot of it I'm not going to repeat. So the reason that debt reduction is so important is because it causes all kinds of stress in your life. Chloe, you can go to the next slide. When you are in a financial crisis, you have depression, you have unclear thoughts and lack of focus, you lose your faith. And so, last month we talked about that life balance of, finance and intellect and relationships and relationship with God and all. And so when you have debt, and when that debt is overburdening your life, then it starts to take over your life and you lose focus. So it's really, really important that we talk about how to become debt-free. Not just reduce your debt, but become debt-free. So, we want to talk about financial freedom. We started talking about this last weekend. And a lot of people always talk about, and many in this room always talk about, I just want to be rich. If I could just win the lotto, then my life would be so wonderful. But wealth is not necessarily about being rich, but it's about having that mindset of freedom and having that peace of mind. I just came back from vacation and it was fabulous, not so much because of the places that I went, but because I was in a foreign country, so I couldn't use my phone. I couldn't use the internet. So I was forced not to work. And so I could sleep as long as I wanted to. If I wanted to get off the boat, I could. If I didn't want to get off the boat, I didn't have to. And it was fabulous because I had such peace of mind of not having to worry about anything. Not have to worry about work, even though I did have my BlackBerry and every once in a while I'd get them frantically running on there. But for the most part, it was that peace of mind. And that's what is so important about financial freedom, is being able to do whatever you want, whenever you want. That's what that rich mindset is. And so that's our goal with this series of workshops. All right, so here are our goals for today. We want to first talk about all the different types of debt, and you will be amazed at how many different types of debt there are, or maybe some of you won't be amazed at how many different types of debt there are. But we're going to suggest some plans of action for you on how to get out of debt, or how to reduce your debt, and I'll give you a timeline on how long to do that, to get out of debt. And hopefully you will leave more empowered today. So here are all the different types of debts. And this isn't a complete list, but these are the ones that we're going to focus on today. So there's basically three different categories of debt. There's the short-term debt, and basically that short-term debt is debt that you would pay off within 1 year, theoretically. All right? Then there's that longer term debt, and that's generally debt that you would pay off in 1 to 5 years. Okay? And then there's that long-term debt that you may never pay off. Or at least it doesn't seem like you'll pay it off in this lifetime, right? So in that short-term period, it's credit card debt. So theoretically, you should be able to pay off your credit card debt in 1 year. Okay? Theoretically. All right? We're going to talk about today. I want everyone to leave here with that mindset that I'm going to pay off all my credit card debt in 1 year. All right? Let's say that together. I'm going to pay off all my credit card debts in 1 year. All right, that's one of our goals for today. All right, then there are things like payday loans, personal loans, and the dreaded IRS. That's our biggest debt. Okay. Then there's that longer term debt, and usually that longer term debt is what we call secured debt. Secured debt. So it's secured by an asset or a liability, like a car. A car is not an asset. It is a liability. Okay? A lot of people think it's an asset, but it's not. Okay? On home equity lines, and then here's some things that are really dear to me because these are things that many of my clients suffer with, and that's medical bills and student loans. And so those are generally longer term debts, and sometimes they turn into long-term debt. So we're going to talk a little bit longer about those because a lot of people suffer with that. And then the long-term debt with the mortgages, and unfortunately, student loans a lot of times go from longer-term debt into long-term debt. Okay? All right, so you got to have a plan. Anyone that knows me, that's been in any of my workshops or come to meet with me, I always talk about having a plan. You got to have a budget. Last month, you just hit it again. We had a budget. Out on the table, there's some sample budgets, but you got to have a budget. And it's got to be written down. A lot of people, usually most folks when you ask them, they say, I have a budget. And then when I ask them to see it, they're like, well, it's in my head. Right, exactly. You got to have it written down. And then you got to write down your actual so you can see if you're meeting your budget. A lot of people say, oh yeah, I'm on budget. And then when they write down, they go, oh, maybe I'm not on budget. Okay? So you got to write down that budget. You have to have short-term goals against long-term goals. So remember we talked about short-term debt and long-term debt. So you got to have short-term goals, the things you want to get done in the next 12 months, or the things you want to get done in the next 90 days, as opposed to what you want to get done in the next 5 years. Okay? Your goal should be to be debt-free in 5 years. It's possible to be debt-free in 5 years. Talking about writing it down, being accountable for it. I'm going to show you some things on how to be accountable. And having a timeline. So, you write it down, you say, this is what I'm going to accomplish, but have a timeline. And then follow that timeline. Say, in 3 months, I want to do this. And then in 3 months, analyze and see if you're at that spot. Okay? And then changing your habits. That's what's most important about this. It's changing your mindset and then changing your habits. And it's hard. It's very, very difficult if you're used to going out every day and spending money, if you're used to when you go to the register just giving them your credit card and then resisting not pulling out that piece of plastic. It's very, very difficult. It's something that you're going to fall off of the wagon and you're going to pick yourself up and come back and start all over again. And then realizing that there is a sacrifice in order to get to that peace of mind. But if you start with that goal of that peace of mind, it will make it so much easier as far as reaching your goals. All right, so this is just a little spreadsheet that I wanted to show you one of the ways that I use to track my expenses. And I generally will start in January with all the 12 months, and I list all of the different credit cards and all, or the bills. And then I determine which ones I'm going to pay off first, which ones I'm going to pay off second. And I always suggest to people that you start with the smallest balance account, just because it makes you feel good when you actually accomplish a goal. And then the next one you want to pay off is the one that has the highest interest rate, because that's going to save you the most money. And so you just sort of develop your plan. So this is sort of how I do mine, and I'll be happy to share that with anyone that wants to see it. All right, so we talked about this last month. 10, 10, 50, 30. 10%, for me, my first 10% goes to God. Automatically off the top. The next 10% goes to me. I say this to people all the time. Why are you going to work if you don't pay yourself? It makes no sense. Why are you going to work to pay somebody else? So pay yourself first. Then the next 50% is that bucket that we're talking about today for expenses and for debt reduction. And then that last 30% goes for your spending money. Yes?
That savings 10%,
Yes.
is that a lifetime scenario?
That is a minimum amount. Glad you asked that. That is the minimum amount that you should be putting aside, and that is your short-term savings. That is not your lifetime savings. That's the minimum amount that you should be putting aside for
Retirement.
not necessarily retirement. No, I said short-term. So retirement is long-term. That is short-term money. So for retirement, then that means you might need to put aside 20%. But you should be putting aside a minimum of 10% because you need to have money to live off of in case something happens. Does that make sense? Okay? All right, so how do we begin? We talked about, you got to change the way you think. That is the biggest part. Once you change the way you think, then your habits and your patterns will happen automatically. The main thing to keep in mind is needs versus wants. Every time you pick up your purse, is it a need or is it a want? And most times what we do is what we want, not what we need. Okay? So we're going to start with, now last month I gave you 22 suggestions. This month I'm giving you 55. So I'm going to talk real fast. Okay? First thing is, you need to have that daily reminder. So out on the table out there I have those little yellow cards that I gave you last month. So that whenever you open up your purse, you see that little yellow card that reminds you don't spend. Okay? There's a back there on that table. And so you're going to put your goal on there, your long-term goal on there. That's going to be your reminder of, maybe I don't want to spend that money today. Okay? Then we start talking about that spending habit. We talked about this a little bit last month. You got to manage that spending. You got to stop that impulse spending. So if it's a purchase and it's not like a regular purchase that you have to make every day, I always recommend to folks to ask the clerk to hold it for 24 hours. If it's that important to you, you'll go back in 24 hours and get it. If not, it'll be sitting there with the clerk. Okay? Only take the money that is budgeted. So remember, we have that budget. You're going to have a budget plan of how much you want to spend per month. Divide that down to how much you want to spend per day. Don't put more in your purse than is in your budget. Sometimes you have to do things to sort of trick yourself into doing what you're supposed to do. Okay? And don't charge what you can't pay. I can't say that enough. How many times do we go and we say, well, I'll worry about that when the bill comes in. Now, if you want to be debt-free, don't charge if you know that when that bill comes in at the end of the month, you can't pay it. Now, I'm going to tell you a little trick I used to do when I first was trying to reduce my credit card debt. I had a little piece of paper in my purse, and it had my balance and my payment date for each of my credit cards. I didn't really care about interest rate because I always paid my cards off. But I would sort of plan my spending by the payment date. So if it was the 15th of the month, and I knew that the due date was on the 10th of the month, then I knew I was already past the payment for the next month, and I was into the second month. And so I would, sort of spread my credit card bills out, and I would keep a little balance there. So I knew how much I could spend per pay period on a credit card, and I just kept track of the balances on a little piece of paper in my purse. So I knew I would be able to pay those bills off each month. Okay? Do we skip a page?
No, we're good.
Okay, all right, so we're talking about short-term strategies. This is credit card debt. All right, one of the things that I want you to know is that credit card companies will work with you. You can negotiate your terms with credit card companies. And I always say you should start with negotiating what's most important to you, and then work your way down to the other things. So, in other words, don't call a credit card company and say, I want to renegotiate everything. I want to renegotiate my rate. I want to take off the fees. I want to take off the late payments. Start with what's most important to you. And if they say no, or if they give you a hard time and say, well, okay, let's try this. Then they want to work with you, so they will work with you on one of those things. So one of the first things is rate. Credit card companies will negotiate rate with you, particularly if you pay on time. They will negotiate the rate. Annual fees. That's a big one. You should always negotiate to not have pay an annual fee. The only ones that you should pay an annual fee on is one that has a loyalty program associated with it. Otherwise, you should not pay any annual fees on a credit card. Now, if you are not able to negotiate an annual fee off of a credit card because of a loyalty program or because of whatever reason, say to that credit card company, well, I do not want to pay an annual fee, and negotiate for them to transfer to another card that does not have an annual fee. Never, ever, ever cancel a credit card. Never, ever, ever cancel a credit card. Now, we'll get into that more when we get into credit, but you never want to lower your limit of your outstandings of all of your short-term debt. So you never cancel a credit card. Cut it up, put it in the drawer, whatever the case may be, but never cancel it. Now, the other thing I want to just remind you, and again, I'm getting into credit, but real quickly. Every once in a while, you want to use a credit card. Because otherwise, the credit card company is either going to cut your limit or cancel the card because they feel like you don't need it. Okay, so buy a pack of gum and pay it off. Okay? Changing the due date. You would never think that that would be important. But if your paycheck only comes on the 1st of the month, and your credit card bill's on the 20th of the month, and you know your money's gone by then that might make it a little bit more difficult to pay it. So you might want to have that payment on the 5th of the month after you know that that paycheck comes in. That's an easy one that most credit card companies have no problem changing. That's one of those easy terms that you can get changed. Waiving late fees. If you pay on time on a regular basis, then every once in a while when you miss a payment, they'll take those late fees off. And they'll take that interest off. You just have to make that phone call. And when you're negotiating, you want to always start with a very pleasant attitude. How are you today? Get them in a good mood. Make them feel comfortable because they'll want to work with you. Now, when they say no, then you want to get a little harder and say, well, let me speak to your supervisor. Sometimes you want to just hang up the phone and start again. Now, if you're going to do that, do it right away before they record it in the computer, so the next person doesn't know that the one before told you no. Okay? But I will call 3 or 4 times before I get something, and then after that, I'll say, I need to speak to a supervisor. Okay? So don't accept no for an answer. Shop around for companies for better terms. I will say to a credit card company or a short-term vendor in a second, well, you know I'm going to call somebody else, or I spoke to someone else, and they gave me better rates. They usually will perk up there. Same thing with your utilities, electric bill, cable bill, telephone bill. Every single one of those you can negotiate lower fees. Every single one of them. And when you say to them that I want to move to a different company, they all of a sudden change their tune. We talked earlier about the strategy of paying off the smaller balances first. It's a mental thing. Paying off the ones with the higher interest rate. Now this next one I want to say very carefully about utilizing zero balance credit cards. If you have no discipline, close your ears for the next 60 seconds. Okay? But if you have higher balance credit cards and your goal is to pay off your credit in the next 12 months, then you can transfer the balances to a zero balance credit card, pay it off, and you're going to pay a lower amount than you would pay on that higher interest credit card. If you do not have discipline, do not do this, because all you're doing is adding on to the debt. Okay? Because for a short period of time, when you transfer that balance, it's going to show up double on your credit report. It's going to show up under both companies. But if you are disciplined enough to pay it off in 12 months, it's an approach that can help to get you debt-free faster. And never cancel your credit cards. Eliminate add-ons. Do you know that Visa, MasterCard, Discover, American Express, they all will cover you if somebody steals your card. You do not have to pay extra for that service. So if they whenever you call them, they always have these little recordings that they see. Hold on, and we have a service to add for you. Resist. Hang up the phone. Say no. They're going to ask you again. No. They're going to ask you a third time. No. That's what they're programmed to do. They're going to ask you 3 times. You need to say no 3 times because those add-on expenses are just unnecessary expenses. Like they'll say that there's the one about, wages. In case you lose your job, they'll pay it. Well, you got to listen to the fine print because what it says is it's only for the amounts that you charge while you're unemployed. Well, when you're unemployed, you're not going to charge anyway. So it's just a wasted expense. Okay? Never, ever, 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 ever pay the minimum balance. That's how credit card companies make their money. They have it calculated so that you will pay forever. That your short-term debt turns into long-term debt if you just pay the minimum. So it always pay more than the minimum. Always pay more than the minimum. And lastly, for short-term, and after this one I'll come back to the taxes. Payday loans. Just don't do it. Just don't do it. I would say the only thing that you would do with payday loans is invest in them. It's a great investment because they make bank money. And they always get their money. They will garnish your wages. It's part of that agreement that you signed. So if you get in that desperate state, surely you have a family member, a soror, or someone that you can come to. Do not do payday loans. If you don't believe me, talk to the big lady. She audits them all the time. Just back to what I forgot about the withholding. I talked about that during the savings. you know, your biggest debtor is the IRS.
Yeah.
You know that, right? Just look at your pay stub. So, to reduce your liability to the IRS on a monthly basis, if you're getting money back at the end of the year, then that means you loaned the IRS money. They borrowed money from you, and you gave it to them. Interest free. Okay? So if you increase your withholding allowance by one withholding, that puts another 2% in your pocket every paycheck. So, you figure out how much you're getting back at the end of the year, calculate what that is as a percentage of your pay, and that's how much you increase your withholding allowance by. Okay? Alright, so we're going to go into longer term debt, those car loans. First of all, stop buying new cars, please. Please stop buying new cars. Wealthy people do not buy new cars. Do you know that? They don't. Because as soon as you come off the car lot, it's 15% less than what you paid for it. That's number one. Number two, negotiating with car dealers is very, very difficult. So you have to come in with your strategy. You have to come in with first negotiating the price. And then negotiate all the other terms. Because they sort of play with the numbers as you're negotiating. So settle on that price first, and then you can settle on all the other terms. Check with your bank and with your credit unions, because generally they will give you lower rates than a car dealer will anyway. Now, once you have that car, you can refinance if your rate is too high. You can refinance. But your goal is to turn that longer-term debt into a short-term debt into a debt-free. Because in many cases, you are in a negative right now. Just like they talk about houses are upside down, your car is upside down. So if something happened tomorrow and the insurance company paid you off, you would probably still owe your debtor some money, unfortunately. So you want to pay off that car as quickly as possible. But the other thing is to maintain it regularly. I love America, but American-made cars don't last long. Okay? So you want to... Who said that? Okay, so Ford Motor Company is doing better. So yay for Ford Motor Company. But you want to maintain the car so you can keep the car longer. All right, again, we're back to that want versus need. We all want a new car every 2 or 3 years, but we just need a car to get us from point A to point B. Right? All right. If you're a safe driver, increase that insurance deductible. If you know that you generally have not had an accident in 5 years, then why are you paying extra for an insurance premium that's only got like a $250 deductible, whereas you could pay a much lower premium at a $1,000 deductible? Okay? Medical bills. All right. It breaks my heart when people come to me to buy a house and they can't buy a house because of medical bills. It breaks my heart. You may not admit it, but at some point in time, everyone in this room is going to face this issue. So, let's talk about it a little bit. First of all, Obama's going to make you get insurance whether you want it or not. In fact, if you don't get it, you're going to start getting taxed for it. So get the health insurance. Let's start with that. Secondly, you want to make sure that when a bill comes in, you want to check that bill, because hospitals make errors all the time. Check that bill very, very closely. When you're checking that bill, know this, that when they know you don't have insurance, they charge you different rates than they do if they know you do. That's right. Insurance companies pay a lot less on medical bills than you do if you don't have insurance. So you want to challenge that bill. You want to challenge the building department and say, I think that service didn't cost that much. I checked with my insurance company and they told me it didn't cost that much. You will be surprised what happens. Okay? Ensure that the co-insurance is being paid. So maybe the first insurance didn't pay it, then that co-insurance should pay it. Maybe your spouse's insurance would cover it. A lot of times the hospital company, even though you gave them that information, they do not forward that information on to the insurance company. And then you end up paying, and then you find out 2 years later, I didn't have to pay that. And you know what the co-insurance company's gonna say? Oh, well, okay? Have a spending account. So this contingency fund, so that's part of that 10%, Joanne, is for those emergency situations. So that contingency fund is for those situations where an emergency like a medical expense comes up. But also health spending plans are a good strategy for when those hospital bills come in. All right? We talked about appealing the charges. If you appeal the charges and the hospital still says no, there are external companies, agencies that will appeal those charges on your behalf and review those bills for you. Determine if you're eligible for Medicaid or Medicare. You may say, well, I'm not old enough for that, but you may have a disabled child. It may be something from your spouse. You may be able to qualify for that. If you've lost your job, you have 60 days that you can still qualify for COBRA and go back and pay for the COBRA. And that COBRA expense, even though it's higher than your old insurance was, is still lower than what you would pay in medical insurance, the medical bills. Okay? Hospitals will work with you. They're required by law to work with you. They have funds available from the government. They have money available from private investors or philanthropists. So they do have money available for the situation for those who cannot pay their hospital bills. There are income requirements associated with that, but you have to ask them for it. They're not going to generally volunteer that information. And this just sort of talks about for the hospital aid, generally if your medical bills are more than 30% of your annual income, you automatically qualify. There are societies like American Cancer Society, Diabetes Association, that have assistance for you if you have those types of diseases. When you negotiate with a hospital, always negotiate for interest-free. They don't charge you interest. Always negotiate for an interest-free payment plan for paying that off. And you must contact the hospital within 6 to 12 months of incurring the expense, or it does show up on your credit. So you must contact them within 6 to 12 months of incurring the expense. All right, here's my other passion, student loans. We have them. It's a fact of life. And we have to learn how to deal with it to get rid of that debt. First thing is renegotiating the terms. You can renegotiate your terms. Those terms may be interest rate. Those terms may be amount that you pay off per month. But you can renegotiate those terms. The goal is, though, to pay off those student loans as quickly as possible without putting yourself into the poorhouse. So one of the first things you want to do is start paying down that principal during the grace period. Most folks take that grace period and say, oh, I graduated, I don't have any debt right now. Well, that's the wrong thing to do because the interest is still accruing. Even though it's a grace period and you don't have to make a payment, the interest is still accruing during that grace period. So you want to start to pay down that principal balance as quickly as possible. During that grace period, any money that you pay all goes to principal. Nothing goes to interest. So start paying that principal during that grace period. You always want to pay off the private loans first, and the reason being that private lenders, banks, are generally not as flexible as the government is. So you want to pay off those first. If you negotiate to have it automatically withdrawn, generally most lenders will give you a break on your rate. It's usually like anywhere from 0.5% to 1%. Now, here's some other things that I personally know that some folks are doing. One is to, start working for the government. If you work for the government, generally speaking, they will pay off your student loans for you in 5 years. So if you're right out of school, it's a great way to get rid of your debt and get some experience under your belt at the same time. Peace Corps and AmeriCorps, if you volunteer for them, they will pay off up to 30% of your student loans if you volunteer for them. There's obviously certain criteria associated with it. Many of our teachers know about the teacher loan forgiveness program that will pay off your student loans in 5 years. There's similar programs for attorneys and for doctors. So if you become a public defender or work at a public hospital for 5 years, you know, those expenses could be in the hundreds of thousands of dollars. So it's very beneficial to do that. Now, this next one works for all types of loans. So if you make a payment bi-weekly, in a year, it amounts to an extra monthly payment. Paying the same amount that you would normally pay, divided by 2, pay it twice a month, will amount to an extra payment a year. So you're not paying any extra money, but you're reducing your debt. And just know, again, I always have to come back to our biggest debtor, the government. You can deduct up to $2,500 of your student loan interest on your tax return every year. Income-based student loan reduction, everybody know about that? That's an Obama program where your student loan payments are matched to your income. Basically, you won't pay more than 15% of your income. And after 10 years, whatever isn't paid is forgiven. Fabulous program. Who knew about that? Yes. It's called the Income-Based Student Loan Reduction Program. It's an Obama program. It's based on your income. Your loan payments are tied to your income. It's not more than 15% of your income. And after 10 years, if you make, obviously you got to make the payments on time. Whatever that balance is after 10 years is forgiven. Yes.
Is that just for the student? What if the parent has the student loan now for the child? The parent plus kind of loans?
I believe it's only for the student, but I can't swear to that, but I will find out for you. I will research that and let you know. All right, yes?
Quickly find out more about that, because is that just for getting an undergraduate degree or just for graduate?
No, it's for graduate degrees also.
So is it, so if you know, maybe let us know.
Yes, I will. Yes, ma'am.
Make sure we all know.
I will make sure everyone knows about that. It's a great program. Yes.
There's an age limit on the.
Is there an age limit on that? I do not believe there is an age limit on that. We do not discriminate by age. All right? Kitty condos. How many folks know about kitty condos? Both of my kids got their college education because of kitty condos. So how a kitty condo works is this. You know you live on a campus. You know you have room and board, right? So you buy your child a condo. You buy them a 3-bedroom condo. In this market, you can buy a condo for $30,000. Okay? So you buy them a condo close to campus. You advertise on campus for a couple of students to take a couple of the bedrooms. That pays the mortgage and puts some money in the pocket. Here, here. And then at the end, you sell it for a profit and pay off all the college debt. It's a wonderful thing. It's called a kitty condo. Now, when I first did it for Shayna, you could do it in the child's name and get a lower rate. These days, it's easier just to do it in your name. Or pay cash for it if you're in that position to do that. But it's a great way to pay for the college education. The other thing that I learned with my second child was, when my first child, I was able to do that, get her in-state tuition, which reduced the debt significantly, okay? And then, of course, again, you know, the roommates paid for the mortgage, put money in her pocket, okay? Now, what I learned with my second child, who was in Tennessee, they would not let her get in-state tuition because she had applied for school before I bought the house. So, what I had lesson learned from that, get the house before they start school, so it gets in-state tuition, which is significantly less. It's usually a third of what it is for out-of-state tuition, okay? And then you get all the write-off for the taxes and the interest and all that. Yes?
Can you still claim, would you have been able to claim your daughter?
Absolutely.
If she filed for
Well, okay, good question.
try to do that.
Good question. Depending on the state. Now, in Tennessee, no, I could not. Right, in Tennessee, I could not. In Virginia, yes, I could. Okay, so it depends on the state if you can or not. So if the question was, can you still claim that child on your taxes? if they are in state in another state. So it depends on the state. In Tennessee, she had to file her own taxes, and I could not claim her on my tax return. Okay? Start saving for college now. Start saving for college for your kids, for your grandkids. When I was coming out of school, my grandfather had started a college fund for all his grandkids. I was the only grandkid that went to college, so woo! But my mother did the same thing for her grandkids. So when she started to save, I saved too. So, you know, when Shayna came out, she was one of the few ones in her class that came out debt-free. Okay? So start saving now for that. That's that future retirement, that long-term savings funds. All right, so mortgages. Same thing. You know, the first thing is you want to get that interest rate down as low as possible. You want to start talking about refinancing. We talked before about making that extra bi-weekly payment. The goal is to pay off your mortgage as quickly as possible. Always, always, always try to make more payments toward principal. Most mortgage companies understand that, but sometimes you have to say to them, this extra money goes toward principal, not toward interest. I just want to say that, and I didn't put this down as a debt strategy, but if you are in trouble, there are programs out there to help you. There's loan modifications, there are deeds in lieu of, and there's short sales, and we'll talk about that in the spring. So this just gives an illustration on what happens if you renegotiate on your mortgage. So I start here, this is with a $150,000 mortgage at 6.5% for 30 years. Monthly payment is close to $950. That $150,000 mortgage over 30 years will cost you $350,000. But if you renegotiate that down to a 3.5%, which is what market is right now, if you refinance at a 3.5%, your monthly payment goes to $373, and the amount that you pay over the life of the loan is $242,000. You've saved over $100,000, haven't paid an extra penny, but your interest has gone down. Now, third strategy. Refinance, but keep paying the same amount that you were paying before. If you paid it before, you can still pay it, right? All right. So that payment over the life goes from $340,000 down to $200,000. And instead of paying it off in 30 years, you pay it off in 17 years. So that's what you want to do. Everyone needs to do that if you have a mortgage. Yes.
So at this point, so I have 20, if I refi now but get a 15, is that better, or should I just refi it first?
I would say that you want to refi down to a point that's comfortable for you. If you can refi down to a 15 years, generally speaking, the shorter the term, the better the rate you're going to get. So at a 15 year, you can probably get it down into the 2s for an interest rate. So I would absolutely refinance it down to the lowest amount that you possibly can. And then always pay over. Especially in the first 5 years. If you look at a payment calculator, and you look at how much is going to principal and how much is going to interest, it's very, very, very little going to principal for the first 5 years. So so if you do that for 1 year, you will have paid off 5 years worth of principal. Let me say that again. If for 1 year you paid extra, and you say, okay, let me look and see how much principal it is for the first year, and just pay that, and each month just start paying more and more of that principal, you can pay off 5 years in 1 year. Do it in those first early years, because that's when you're paying more interest than principal. Yes, that's okay.
So should I stay with the same mortgage company that's had it for 10 years?
Excellent question. The question was, should you stay with the same mortgage company? I always recommend you start with who you have your mortgage with, because they want to keep your money. They're going to try to negotiate the best rate for you, and they generally won't charge you much upfront cost to do it. They generally will do it for free, and they'll even send somebody to your house to sign the paperwork. So you always start with your current mortgage company. All right. Now, I have here other strategies because I do not condone any of these methodologies, but they're out there and they are things that people have to sometimes deal with. Debt consolidation. Never ever will I ever recommend that to anybody, but some people will do that. Most debt consolidation companies are scams. I will say that again. Most debt consolidation companies are scams. They charge you a fee. Sometimes they do the service, sometimes they don't. But most of the time, in most cases, whatever a debt consolidation company is doing, you can do it yourself. All right? So what a debt consolidation company does is they gather all of your credit card debt and they negotiate supposedly a better rate, and then you pay them and then they pay all your different creditors. You can do that yourself. All right? So I have it out there. Bankruptcy. I will never, ever recommend bankruptcy. But in some cases it will happen. Chapter 13 is a consolidation debt program, just like you do with a consolidation company, except there's a trustee, you do it through the courts. It's on your credit for 10 years. Your credit score is going to go down. Minimum 100 points. Minimum. All right? Other is chapter 7. Chapter 7 is basically you reorganize your debt and pay it off. I'm sorry. Chapter 7 is liquidation, where you are forgiven for all your debt. They will take some of your assets, so your cash or your car or whatever the case may be, but then you're forgiven from the debt. All right? So know your rights very quickly. Debt collections, they cannot call your job. If they're calling you on your job, the next time they call, tell them you're calling my job, they will hang up. It is illegal. They cannot do that. However, they can call your coworkers, they can call your family and get your information. That is legal. They can do that. They cannot harass you, they cannot threaten you. That is illegal. They cannot publish your information to other creditors. That's illegal. If you contact them in writing and say, don't contact me anymore, they have to stop. Okay? So as I said, they can call your friends, they can sue you, they can garnish your wages, and they can seize your property. All right, so I hope everyone learned something today. We will publish this one just like we did last month on the websites, on Facebook, on Twitter. If you have any questions, that's our email address, cacecondev@gmail.com. And I hope that you all learned anything. Remember, everyone tell 1, 2, 3, 4, or 5. All right, and we'll see you next month. Next month we'll be talking about trust, wills, and life insurance. Thank you.